Glad to be here virtually this year. It's been, of course, a very strange year, both politically and of course, with the COVID-19 virus. This has been pretty remarkable. I used to talk about the 2008-2009 recession and describe that as the recession of a lifetime. But apparently I've lived too long because the recession that we just went through in 2020 was in fact deeper than the recession of 2008-2009. So there's some similarities between the recession that we went through last go around, which has come to be known as the Great Recession, and the recession that we just went through here in 2020. And there's also some key differences, and these are important in particular for Florida. This recession was really historic in that it was unlike any recession that preceded it. It didn't happen from within the economy. It didn't happen because there was an economic shock outside the economy that triggered changes in the economy. There wasn't a currency crisis. There wasn't a dot-com collapse. There wasn't a credit freeze. This recession was, in fact, self-inflicted. When the public health measures, the lockdowns were implemented and the government made the decision that, your business is non-essential, your business is essential, those non-essential ones must shut down. There was no ambiguity about those orders. This was not the way the economy typically goes into a recession, where businesses are, kind of questioning what's happening to the demand for their products. Oh, we had a down month, or this quarter was a little bit weak. Well, let's wait and see what the next quarter would bring, and start making decisions then about layoffs and so on. But here it was instantaneous. The government said we're going to shut down. Originally, it was 2 weeks. I'll come back to that in just a second. 2 weeks to flatten the curve, which we successfully did, but in the process, we bulldozed the economy. That shutdown, there was no uncertainty at all for those businesses. They were no longer allowed to sell whatever goods and services they were providing. And so their revenues fell immediately to zero. It wasn't that demand started to wane a little bit and questions began to arise about the health of their business or the health of the demand for their products. They knew right away they had to shut down. And so there was no waffling or wondering, do we need to reduce hours? Do we need to furlough or lay people off? That was very clear. We're shut down. We don't need employees. And so what we saw happen there is really just unprecedented. So the 2-week shutdown stretched into, for most of the country, 2 months, much longer than that in some parts of the country still. And that pushed the economy into recession. And in fact, the National Bureau of Economic Research, the NBER, which is a think tank in Massachusetts, who puts turning points, they date the turning points of the business cycle. So they say in this month and this year we hit the peak of the cycle, which means that after that peak we were in recession. They very quickly came out and announced that the peak of our expansion occurred in February of 2020. Which meant that after February, we were in recession. And typically it's 12 or 18 months before they come out and officially announce a date, because there's uncertainty in your average recession as to when exactly it began. There was really no uncertainty, no ambiguity. The lights went out. We pulled the plug in March and in April. And so the economy plunged. And we saw in the second quarter real GDP fell by 30% at an annual rate. I mean, just a tremendously deep plunge in the production of goods and services in the economy. And so the layoffs and furloughs began simultaneously. And so that was different than a traditional recession. In a traditional recession, businesses don't have a slow month or a slow quarter and immediately start laying people off. The labor market normally will tend to lag behind the activity in the economy itself. And so unemployment and layoffs tend to happen after the economy is in recession with some lag. And the unemployment rate typically rises fairly slowly And that was even the case in the 2008-2009 recession. It took a year and a half really to hit the peak level of unemployment in that recession. This time around, it was a matter of weeks. Nationally, we had 30 million people plus thrown into unemployment, applying for unemployment benefits, just a massive amount of workers losing their jobs effectively all at the same time. And so this is, shouldn't have come as a surprise, overwhelmed the unemployment insurance system. And so the recession, it's not been declared officially over. In my mind, I believe it ended in May, maybe June at the latest. Third quarter real GDP grew faster than 33% at the first measure, the first take on it. And so, we bounced back pretty sharply. And I would call this, or I refer to it as a bent V-shaped recovery. The V-shaped recovery implies a certain symmetry of the recovery phase to the recession phase. That is, one's a mirror image of the other. So we know exactly how deep the recession was. I don't think that the recovery is going to be exactly as sharp as that recession was. So I think it's going to be a V, but with a little longer trajectory and not quite as steep. But nonetheless, I believe it's underway, and in the third quarter we saw that data supported that thought. I think it will continue, this recovery, as long as we don't go back to these shutdowns. And so there's talk of it. I know here in Florida the governor has said we're not going to do it. There's talk about it nationally. Some states are starting to implement these lockdowns again in various forms. But I mean, that will, if we went back and did again what we did in March and April, the first go round, we would certainly plunge back into a recession. I think it would be worse than the one that we just came out of. I think that the consequences would be far more severe, and I think it would be longer lasting, and the damage that was done I think would linger on for many years. Last time we met in person, which I think was 2019, I don't even know what year it is, quite frankly, I started to talk again about the national debt. And I'm just going to reuse these slides here. If you've attended that 2019 talk, you've heard this before. But it's something that I've written about in our U.S. forecasts at the Institute for Economic Forecasting for many years because it receives so little attention. But with the coronavirus public health lockdowns and the damage that did to the economy, we saw, the CARES Act, $2.2 trillion very quickly put into play. And we saw tax revenues plunge as businesses were shut down and people were laid off. And so the national debt has risen significantly in 2020. It was already high back in 2019. But now we're talking more than $27 trillion of debt and rising as we speak. And so this concerned me. It concerned me even more, back in 2019 as the political process was playing itself out in the start of the presidential election, because there's a couple of things that were being discussed and still are being discussed, and pending the final results of all the federal elections, some of this could actually happen. But there are politicians that were calling for new entitlement programs. Never mind the fact that Social Security and Medicare are actuarially in trouble and demographically doomed in their current form. We want to add some new ones. The proposals go. That's Medicare for all, for example, or another shot at clean energy here. The Green New Deal, which is estimated by many to have a price tag in excess of $90 trillion. And I would imagine that price tag is probably significantly higher than those estimates. So where does that money come from? Well, we don't have that kind of tax revenue coming in, so we would have to run deficits to spend like that. And when you run deficits, the government has to issue debt to finance those. So you've got these new programs of existing high level of debt, and lastly, there's a fringe group, I'll say, of economists that are pushing this notion known as modern monetary theory, that at the heart of this idea is that the debt doesn't matter, that the government can continue to run up this debt and finance all these programs with no ill consequences. And so that worries me. When I see all these things sort of converging and I see the debt now above $27 trillion, I start to get nervous. So what would Jay-Z have to say about our national debt in excess of $27 trillion? Well, it'd say, we got 27 trillion problems, but Fitch ain't one, at least not yet. Now, some of you might have to Google that, but Fitch, of course, is one of the bond rating agencies like Moody's and Standard & Poor's. And so despite the fact that the U.S. has over $27 trillion in debt, the rating agencies still give federal debt the highest possible rating. It's AAA debt. And in fact, U.S. government debt is the ruler by which all debt is measured in terms of default risk. And it's considered to be default risk-free. So it seems like, 27 trillion, it's not hurting our credit rating. At least it isn't yet. And that's the concern. The level of the debt doesn't really matter that much. For example, in 2010, Greece had a debt crisis. When it came to a head back then, they had a total debt of $380 billion. I mean, we run that up in a matter of weeks around these parts. But that was enough to trigger a debt crisis in Greece. Why? Because it's not the level of debt that matters, it's your ability to service the debt. And so if you're talking about sovereign debt, that ability can be gauged by looking at the debt to GDP ratio in the economy. And so this next table is a list of countries around the globe that have the highest debt to GDP ratios on the planet. And you can see the United States is there. We're now at 137% debt to GDP. Our previous record high, that's the highest it's ever been. The previous record was post-World War II, when the debt to GDP ratio got as high as 107%. Well, we're not fighting World War II right now, but yet here we are with a debt to GDP ratio of 137 on a list of countries, quite frankly, that is not the who's who of good fiscal management around the planet. There we are with Greece and Congo and Mozambique and Jamaica. So we do have a high debt to GDP ratio, and it's rising. And that is something to be concerned about more so than what the actual level of the debt is. And I said I'd conclude this section about the national debt by drawing from Ernest Hemingway, who in The Sun Also Rises wrote an exchange between two characters, Bill Gorton and Mike Campbell. Now, Mike had gone bankrupt, and so the characters who were sitting in a bar, which is a very unusual setting in Hemingway novels, were discussing this, and Bill said, Mike, well, how did you go bankrupt? And Mike responded, 2 ways, gradually and then suddenly. And I think it's very an apt point to make. We're not going to get a 15-year, 10-year warning from the market that there's going to be a crisis because of our national debt. These things gradually build, and then suddenly the crisis is upon you. There was no warning to Greece what was going to happen in 2010, other than the fact that their debt continued to rise, that their debt to GDP ratio continued to rise until it hit an unsustainable level. And we don't want to go where Greece had to go, where they were cutting the pension payments to retirees. We don't want people in this country around Social Security to suddenly get the word that, oh, your checks are going to be 50% of what they were. So here we've got to look at the U.S. budget surplus. In this case, all the numbers are negative, so these are all deficits. And you can see, we used to think $1 trillion deficit was just eye-popping during the Obama-Biden administration. But we're going to push close to $4.5 trillion this year in terms of the deficit. And it will shrink as the economy recovers, but we're still going to be looking at fairly large deficits for many years to come, unless there's some changes to be made here. The labor market nationally, of course, you shut down large sectors of the economy, people lose their jobs. And so payrolls, we saw just millions of people losing their jobs over the course of a month. And then when the economy was turned back on, many of those, not all of those, were rehired. Small businesses, I think, disproportionately have been hurt by these lockdowns. Lower income workers have been disproportionately hurt by these lockdowns. These are the people that couldn't sit at home and Zoom all day, like some of us were fortunate enough to do, and continue to receive a paycheck. The damage there was quite profound, and it's unfortunate because that was a group, these lower income workers, that were doing the best pre-pandemic. They were seeing the fastest wage and salary growth. This is a website. I won't say too much about it because of time, but it's called Tracktherecovery.org. It's very useful. It's a relatively new endeavor from Harvard and Brown, I think, with funding from the Gates Foundation. But it uses private data that's as close to real time as you can get to measure how the recovery is playing itself out. We get monthly initial claims for unemployment insurance, or weekly rather, then we get the monthly jobs report, and every 3 months we get a GDP report. So government data comes out with a lag. They use private sector data, debit card transactions and things like that to put together an outlook for the economy. They break it down by state, and just a lot of good information there. It's particularly useful given the unique nature of this recession and recovery. So I think the U.S. economy will see faster growth next year. I think that the COVID-19 vaccines, of which at this taping there are 3 that are in the final stages of approval, all with 90+% effective rates. So that, I think, is going to help put this pandemic to bed, if you will, as we work our way through 2021, and that'll allow the economy to accelerate. Uncertainty, yes, but this is a big hurdle to get over, to help alleviate some of the fear that has stopped people from traveling and doing all the things that we normally do. So the vaccines are important. There's still uncertainty as well politically. We have an election that has not been 100% resolved, in particular the Senate, so it's not clear if the Democrats will have control of all 3 houses again, or if the Republicans will retain control of the Senate and the Democrats have the House and the White House, presumably. It's hard to say, but if until we know that, the policy path is a bit unclear. Obviously, I think with a Biden administration, we could see a movement back towards those policies that were in place during the Obama Biden years. Executive orders, things that can be done without the full legislative process can happen. And so I think generally speaking, those kind of policies, at least what's being discussed right now, would push down my projected growth rates. But again, the extent to which this is going to happen really depends on the full and complete outcome of the election, and of course I'll revise these forecasts once that's known in January. You can see the quarterly swing, just an incredible plunge in the second quarter nationally. It's not surprising, but it's shocking every time I look at these numbers. I mean, it should come as no surprise when you shut down big chunks of your economy that the production of your economy falls significantly. But just seeing the numbers in black and white, I think, can be quite a shock. What about Florida? Well, we're not immune, certainly, to what was going on with the pandemic, and in fact, perhaps somewhat more susceptible because of the importance of the tourism industry, which took a hit during this recession and during this pandemic, unlike any it's ever taken. And so, we see a pretty sharp decline in state GDP for 2020. I think 2021, things are going to rev up. I think the labor market's going to continue to heal. We had an incredible labor market in February. Less than 3% unemployment statewide. As I said, lower skilled, lower income workers were making the fastest gains in terms of pay raises. And the biggest problem in the labor market was finding workers, not finding jobs for workers. And so we've sort of gone back to a taste of what we went through in 2008, 2009. But it's not really the same. And I'll come back to that in just a second here when we talk about the housing market. But you can see, compared to year over year, Florida is still down versus the previous year for a couple of more quarters. But the economy is recovering. Tourism not quite as quickly as the rest of the economy. The housing market, unlike 2008, 2009, has done quite well, if you will, through this recession and this pandemic. And that's important. It's important for local government finance. It's important because last time that lost equity, that plunge in home prices that you see shortly, weighed on consumer spending for many years in the state of Florida. And it took us a long time to come out of that recession because of the burden of what had happened in the housing market. And so sales continue to rise. Prices continue to rise. Median prices statewide are at $300,000 as of last report. That's well above the $254,000 that was the peak of the housing bubble before that collapsed. And so prices are rising once again in double digits. And if you look statewide, you can see 13.2% increase in prices year over year. Is this again a bubble reinflating? No, because of the bottom row. There's only 2.2 months of inventory for the entire state in terms of the housing market. A balanced market should be 6 to 9 months. Sarasota, similar problem, right? And these were the same problems we had pre-pandemic. There's not enough housing. There's a shortage of housing, and that's driving up prices. You could see median sales prices here, not double digits for single family home, but you could see the inventory has shrunk dramatically, less than 2.1 months. It's just not enough, and prices will continue to rise as that shortage remains in place. Condo market as well here in Sarasota County. Inventory 3.5 months, down year over year. Prices rising at a very strong clip. So the bottom line really in housing locally and around the state is there's not enough of it. And when you have a shortage in a market, that puts pressure on prices to rise. We haven't, as I said, built fast enough to keep up with demand. Population growth, economic growth in the Florida, pre-pandemic was much faster than what we saw nationwide. And more people, more economic activity means greater demand for housing. While all the drivers of demand were growing, the supply was not. Housing starts were plateauing from one year to the next. They might go up a little bit. But really, that's the issue in the housing market is the supply side. Population growth will resume again in Florida. I'm sure it was interrupted temporarily because of COVID, maybe accelerated because of COVID as people were sort of fleeing states where there were tougher lockdowns, and of course weather's always a factor, and the baby boom generation continues to age, and so we will continue to draw our share of those retirees. And population growth and economic growth are two sides of the same coin, quite frankly. Unemployment in the state spiked faster, spiked higher than we saw at the peak during the 2008-2009 recession. So the labor market in Florida was harder hit by this short and steep recession than it was by that also steep but very prolonged recession in 2008-2009. You could see the outlook here for the state, for state GDP. The recession and this sharp recovery that we're seeing really makes the 2008 recession recovery look like a bump in the road. And that was a pretty severe recession by historical standards. Employment in the state, again, is recovering. Not all sectors are recovering at the same pace. The construction sector fared well throughout the recession. Major public works projects continued onward. This was not something that had an impact on construction the way the last recession did. Professional business services, everybody that could Zoom kept Zooming. Most people kept their jobs. Some support services for business were impacted, and I think that's because of small business, but the recovery there is pretty good. Here's the problem. Florida's leisure and hospitality employment, that sector devastated. Air traffic plunged 98% year over year to Florida in March and April. I mean, that is as devastating as it can get in terms of visitation. Hotels shut down, conventions canceled, vacations, postponed. All of that really contributed to a tremendous blow in that sector. But the vaccines are really going to be a key to getting tourism back on its feet, and I think it will. There's a lot of pent-up demand out there, as there is with every recession. This is spending that people don't make during recession, even if they're working and their income hasn't changed because they're uncertain about the future. And then when we get out of the recession, that pent-up demand is released and that spending happens. So not only do we have pent-up demand, I think we have pent-up demand squared, because we've not only not been spending, we've been pent up in our homes with people that were formerly known as our loved ones. Looking statewide, these are the sectors we think are going to grow over the next several years on average. Leisure and hospitality up at the top, and of course that's from a very largely depleted base of employment, because much of the job loss was in those sectors here in the state. What about Sarasota County? Again, no escaping what happened here. You could see the output of the county took a dip, a significant dip in 2020. That's going to turn around, and we're going to get back on track starting next year. I think you'll see output in the county get back to where it was pre-pandemic, probably 2022. I think it's going to take at least next year and then some. I think that the snowbird impact on the economy might be somewhat muted this year because of COVID-19. But again, that vaccine is, those vaccines, I should say, once they're widely distributed, COVID becomes a much less important issue in terms of its economic impact. Payrolls as well, the job market takes a hit, when tourism suffers the way it did. Housekeepers, clerks, et cetera, at hotels and other tourist-related establishments, furloughed, some temporary, some permanently so far. It'll take a while for the labor market to recover. I think the economy in terms of spending gets back more quickly than the labor market, because these small businesses that didn't survive these shutdowns, those proprietors, their employees, it'll take time for them to get back into the labor market. They were hurt. Disney and Delta Airlines were always going to survive this pandemic. It's the independent resale shop, the coffee shop, the family-run restaurant that didn't have cash reserves or didn't have access to capital markets that they could just batten down the hatches and close up for months at a time and come out on the other side unscathed. Population growth, I think, will continue here in Sarasota County. As I said, there may be some pause here as we work through the tail end of this COVID pandemic. But again, look at the national demographics, the age structure of the economy, the traditional draw that the county has for retirees, and then of course the jobs that creates when you have more people in a regional economy, and those workers will be moving to the area as well. And so again, government's in pretty good shape. Didn't take the hit that we saw last go round. I think the biggest problem is in the short term getting this vaccine out and distributed, and once that's done, I think housing goes back to the top of the list, and affordable housing as being the major economic challenge for the region. Our quarterly forecast publications are available on the Institute's website for free download, Florida and Metro forecast, and then the national forecast. And starting in 2021, the Florida and Metro forecast will include forecasts for every metropolitan statistical area throughout the state, including here in Sarasota. So there's something to look forward to in 2021. Thank you very much for virtually coming out to listen to me today. I look forward to the chance to see you in person next year, and I'll be happy to take any questions.